This is kind of weird because stocks bled out today after two Fed officials came out implying of rate cuts at this next December meeting. And everybody's kind of wondering now, all right, is this the start of something much bigger that's about to happen, or should we just buy the dip like last time? So today we'll talk about what those two Fed officials had to say, what it means for the December rate cut, and why stocks sold off today because that's good news, right? So, first up, Philip Jefferson. He's the Fed's vice chair. He's basically Powell's right hand voice. And what he talked about today was his economic outlook and monetary policy. He started off saying that he sees moderate economic growth through the end of this year. It's not a boom, but it's not a recession either. Risks have shifted, less worried about this inflation number rising, but more so worried that the labor market continues to weaken. So inflation risk is down, employment risk is up, and that's cut friendly. Then he gets to talking about this labor market and how it's gradually cooling. He points out some of the recent economic data, which is unemployment claims, for example, that point to this gradual cooling in both labor demand and supply. He says that he expects that 4.3% rate recorded in August for unemployment to trend up by the year end. And as far as when he checks out some of these firms, they're showing like this mixed bag because we have some of these firms that are cutting back hiring, and then you got some of these other firms that are planning to delay hiring or capex spend. So he says that the downside risks are what he sees for employment. And that's the Fed's way of saying, we're getting kind of nervous about this job market. And historically, when the Fed starts talking about the employment risk over the inflation risk, you're usually closer to the middle of a cutting cycle rather than, say, the beginning. Think back to 1995 when this blue line right here, you see it, that's the unemployment rate, was easing down, but the Fed still decided to follow through with this mid-cycle insurance cut. Probably not because they were expecting it to get really bad, but just to kind of avoid something that could possibly happen. Because, yeah, they still went through this recessionary period in '01. Eventually, it was quite a while out, like, 5 years? But they were probably trying to avoid something more so like this '08 subprime mortgage collapse. And look what happened to this unemployment rate there. So they kind of navigated that one appropriately, if you'd argue. But now back to Jefferson, he then gets in to talk about inflation and how, yeah, headlines running a bit below 3%, the same as a year ago. And when I read that, I'm like, ugh. So inflation's proving to be sticky. It's not really moving down. That's bad. But then, and he talks about how their progress has stalled. But then he kind of backtraces and says, well, I mean, that's because of tariffs. Those are tariff effects. And those are one-off price increases, not this new inflation spiral. And his base case is that these tariffs, it'll create a one-off bump in the price level, not ongoing inflation. And then he points out how these near-term inflation expectations have cooled back down after that spring tariff panic. And then these long-term expectations, those are still anchored. So if the Fed believes inflation is this one-off tariff story and expectations are pinned down, they're not really moving much to manifest inflation somehow, that's a green light to focus more on this labor market that they expect to slow. And that's why he backed that last cut. He probably will back this next cut as well. He says that policy is still somewhat restrictive where it's at right now. So he's still saying like rates are a little bit too high than where he'd rather be. But he does go on to say they're moving closer to the neutral rate, the interest rate level which neither stimulates nor restrains the economy. And then he drops this line. I thought this was interesting. The evolving balance of risk underscores the need to proceed slowly as we approach the neutral rate. So he's pretty much saying like, hey, I support this cut, like maybe December, but don't get your hopes up and think we're just going to start cutting all willy-nilly. Like, we're going to take it data by data piece and then based off of that. So December's probably baking into the cake from Waller's point of view, like it got his vote, but moving forward, it's gonna depend more so on how the data comes in. And then he gets into talking about the balance sheet runoff and why that ended. He explains the Fed stopped its balance sheet runoff in December 1st. Since 2022, the Fed has shrunk its securities holdings by about 2.2 trillion. I think we covered this a while back. And recently what they're showing is that repo rates started trading above what the Fed pays on reserves. So the standing repo facility has been used more often. And then the effective funds rate has crept up relative to the interest on reserves. And all of that signals that reserves are moving from this flooded to this ample level. Like, when your mouth is just kind of dry and you need like some water in it, it's kind of like a desert out there. It's kind of where we're trading. And they don't want to repeat that 2019 money market freakout scenario. So they're parking QT here, that quantitative tightening. It's going to a halt. And moving forward, balance sheet size will be held roughly constant for a little bit. And as these mortgage-backed securities, these MBSs continue to mature and roll out, those proceeds that they make upon maturity will be reinvested into treasury bills. And that'll really shift the portfolio towards these treasuries and shorter durations over time. So from Jefferson, what we got today is that, growth is pretty moderate. Job risk is skewed to the downside. Inflation, it's stuck near 3%, but that's because of tariffs and expectations, which kind of impact inflation away. Those are anchored, and that's in line with what we want. He says that Fed policy, it's near restrictive, so that justifies cuts, but just slowly. Quantitative tightening, they're pausing that, which we already knew that, so they don't break the funding markets. And that's really a dovish leaning risk management stance. Now, let's talk about what Christopher Waller, and what he had to say. So if Jefferson is Powell's right-hand man, you'd say Christopher Waller is more so like this guy applying for the new Fed chair position coming up, the end of February or March of 2026. So he basically comes out today and he's like, hey, we're not flying blind. The data we have now it's enough to know that the labor market's weak. We've already been forecasting this, and therefore we should cut in December. And he talks about how he hates this data blackout narrative and that this idea that the Fed's completely helpless without the government Fed data. And then he goes on to remind everybody, like in 2022 when the Fed was hiking aggressively, traditional models said that the unemployment rate would spike. But Waller instead looked at what this beverage curve, whatever you want to call it. That's the relationship between job vacancies and unemployment. And in his no big layoff spike call, he ended up turning out right, even though some of the official data they look at was pointing otherwise. Then in 2024, the hard payroll data was still showing strong job growth, but business anecdotes and private data, they were flashing no higher, no fire. And he said the labor market was weaker than the official data, and when these revisions came in, sure enough, the numbers were slashed. Again, soft data beats the first print. So his point he's making is that you don't need this perfect data to see the direction of travel. Rather, his read right now is that jobs are near speed, and you could use other data sets out there. There's all these alternatives to get there, like ADP and claims and surveys and job challenger gray layoff announcements. And he goes on to talk about how the labor market is stall speed, and ADP's monthly data from May to that October range basically showed minimal net job creation. Challenger reports 1 million job cuts announced so far this year, which, remember, that's up 65% from last year. So that's quite the increase. That's like a crypto chart in a bull run. Job postings, quit rates, and it's hard to hire. All of those stories are fading away. And then Chris Waller goes through this textbook supply versus demand analysis for labor. And if this was mostly a labor supply issue, fewer people willing to work, wages would be ripping higher. So in order to get people to work, hey, forget $10 an hour, we'll pay you $15 an hour. vacancies up, everyone complaining they can't hire. That's kind of telling this other story. Instead, we're seeing weak demand, slower hiring, more layoffs, fewer openings, longer job searches. So Waller's conclusion here is that this is more demand side weakness, and when weakness in jobs is demand driven, that's exactly when monetary policy should, step in and kind of help. And then he gets in to talk about inflation, which in his opinion, we're close enough to that 2% target for risk management. So on inflation, he talks about how CPI through September hit that 3%. Where are we at on that? Man, I lost my place. Yeah, right here. So he begins talking about how they're close to this 2% target, but that's because of tariff impacts. And without tariff impacts, the real impact of inflation is actually treading down closer to the Fed's target. So far, the tariff effects are smaller, they're more gradual than people ended up fearing. And then you look at inflation expectations. What do people think is going to happen in the future? Just like Philip Jefferson said, they remain well anchored despite inflation being 5 years above target. So he doesn't really see the story where inflation suddenly reaccelerates with this weakening labor market, expensive housing, and strained consumers. So with inflation near this 2 to 3% range, and it's pretty stable there, the labor market clearly weakening, and all of that, once you consider that and bake it into the cake, he supports another cut coming December for risk management. And his line is basically, all right, if I'm wrong and the labor markets somehow magically reaccelerates and nothing's wrong, we can always stop cutting. But if he's right, we don't have to cut. We risk this sharper employment downturn that's harder to fix. So you could always cut and then choose not to cut. But you don't want to choose not to cut when you should have cut because of the effects. Now, he also spends some time on some of the stuff regular people actually spend money on. He gets into like housing costs and loans and stuff. And he begins talking about how mortgage rates are still north of this 6% figure, way above the sub 4% world where we've had for most of the 2010s all the way up to 2020 dang near. And since 2020, the income needed to afford just the median house is up 50%. Actual median incomes, they're only up 26% through 2024. So affordability has completely blown up. First-time home buyers and low-income households, they're getting squeezed the hardest because they already make less than people. It's the asset winners winning, and rich people are who owns the asset, so they're less likely to be lower income, median income households. So even with the prices, if they stop rising, inflation goes away. And inflation is the rate at which prices rise. Just because inflation went away doesn't mean prices go down. That's deflation. So even without prices rising, the payment's still brutal for these lower income cohorts. And then they get in and talk about how this auto industry with an average 5-year auto loan rate was 5.3% back in 2019. Now it's 7.6%. So the weeks of median income needed to buy a typical new car from 32.8 weeks pre-COVID is now 37.4 weeks now. So between price hikes and higher rate cars and all of that eating a bigger chunk of income too, there's more layers on this stat that Market Watch gets into. So I was reading this one, and they begin talking about how much cash you need to strengthen your financial well-being. And I might make a video on this one. I thought it was interesting because they get in to talk about how in September there was this survey, and 74% of Gen Z, 61% of millennials, 55% of Gen X, and 33% of boomers did not even have $2,000 in accessible cash in case of an emergency. So even among households, they get in to talk about, all right, 100,000 and over, 39% didn't have that 2K buffer. So when Waller talks about houses and autos and how there are ongoing challenges for consumers, and especially lower and middle income, That's not some made up theory. Waller's onto something because most people don't even have $2,000 for an emergency. And cars and houses are more expensive now. And that's the part that really worries him, and honestly should worry the Fed more than whether CPI is 2.8% or 4%. So if we put this together, really what this means for December 10th, the Fed's day that they will announce what they want to do. Jefferson's risks shifting towards jobs, policies somewhat restrictive, move slowly but keep easing. Waller underlying inflation basically on target. Labor market demand clearly weakening. He wants another 25 basis point cut in December. These are all core board members. So yeah, it's not guaranteeing the December rate cut, but it shifts the center of gravity for the Fed towards easing. And we'll have to watch some of these wild cards that will kind of move these numbers. It looks like we're 42.9% for the Fed cut of 25 basis points. But we'll get into that here in a sec, because we got to talk about what markets did today and some of that price action. So despite the Fed members coming out and supporting cuts, that's what everybody's been wanting forever. The NASDAQ, if I pull this up, we got to go in order. That's down 0.84% today. The S&P 500 down 0.92%. The Dow Jones, that one was down 1.18% today, logging its worst 3-day stretch since April. Bitcoin, that one's really bleeding, 4.57%. When I started this video, this was only down 90 to 92,000. We're heading down to 90,000 right now. Woo! So why is people panicking when the Fed's possibly talking about more rate cuts down the road? I think it's because the market's really dealing with these two opposite fears at the same time. So the first one will be this macro fear. If the Fed has to cut more, maybe the labor market really is rolling over and it's getting bad out there. And what if people lose their job and they need to sell their stocks? And everybody kind of has to do that simultaneously at the same time. And then the second fear is this valuation fear. What if AI and mega cap tech just got too expensive and the earnings just don't justify the valuations of some of these stocks? So then today we got Amazon. They're moving forward and dropping a $15 billion bond issuance to fund more cloud and AI infrastructure. And on one level, that's kind of bullish, I'm not going to lie. You got big tech doubling down on AI despite all of the headlines and everything. But then you look at this from another level. Bond investors are looking at this circular nature of this AI build out. You got companies like OpenAI and some of these other startups who lose a ton of money on trading these LLMs, these large learning models, language models. And they spend that money on chips from companies like Nvidia, Microsoft, Amazon. And those companies then use that cash flow to justify some of their valuation and build up even more infrastructure, partly funded with debt. Can't leave that part out, like this $15 billion deal. But if the startups never turn profitable and at some point aren't able to give cash, that cash coming in from their AI customers, from Amazon, Microsoft, for example, it then has to be replaced by end user demand, not just VC, these venture capitalist funds who are just lighting money on fire just because they got so much of it. You want some more to light on fire, you little cold? Here, light this up. So Wall Street, they're looking under the hood now at those flows instead of just vibing on AI. And then next week, the wild cards were as early as 2 days from now, a huge one. The stock that basically is the central bank of AI hardware, Nvidia. We got Nvidia earnings coming out. That's the poster child of the bull market. We'll probably get another beat, but everybody wants to know how much will be and what's forward guidance look like. Are people still way overspending on these NVIDIA GPUs? Then Fed minutes on Wednesday. We'll get color on how divided the committee really was at that last meeting. If the minutes sound more dovish than the headlines, that supports Waller's camp. If they show serious concern about cutting too fast, maybe you're kind of hopeful for these Fed cuts you might not get in December. And then Thursday, that's the big one. We'll get the September jobs report. The consensus is that we'll see slower hiring, but the real question is, are we drifting down to this 30 to 50,000 jobs per month range, like drifting down? Or is it something ugly that screams demand shock? And then now the Fed's got to react. So that combo alone, that will set the tone for this December meeting and probably where the market heads next, because they want rate cuts, but because lower rates, like that's easing financial conditions, right? But it's the reason behind those cuts that leaves everybody like a little scary. So that's what we got today. We got Jefferson and Waller. They're supporting these cuts for similar reasons. Markets, they see suspicion with that. They're nervous. They're not panicking though. We're not seeing these forced liquidations or margin blow-ups or some credit crisis jumping out of nowhere. But yet, we don't know if this AI valuation is justified right now. We don't know what the Fed's going to do with the rates. And if they do something with the rates, what's the reason behind it? So we'll keep on covering everything that's going on. Since everybody doesn't have $2,000 for the majority's sake, I think I might make a video talking about some ways to kind of view your financial life and possibly save a little bit of money. So let me know if you're interested in that. But otherwise, y'all, just be careful out there. Stay sharp. Stay willing to learn, everybody. And I'll see you in the next one.